Welcome to our Stearns Financial Group live chat. Today we're going to be talking about all things taxes, and I'm joined by a number of our members of our planning team. We have Dixson, Glenn Joyce, Teresa Talton, and Tara Maxwell. So welcome everyone. One of the big issues on taxes that has certainly created the need for this update is the proposed changes to the tax law, which we have scant details right now. We have some general outlines. And the reality is that there's still a lot of tried and true planning, whether you're under that $400,000 income, taxable income number, where maybe you don't get affected as much by the new tax law, whether you're between 400,000 and $1 million or over $1 million of taxable income. The fact is, a lot of the things we're going to be talking about today are tried and true tax techniques for helping minimize or mitigate tax impacts for anybody up and down the chain. So some of this is going to relate to some of the new tax law that may be coming, should be coming. But some of it may relate to just regular tax planning that needs to be done. We do want to answer your questions if you have them, and we have tried to sprinkle in a lot of frequently asked questions from our clients into this presentation. But if you have another question on another matter, please put it in the Q&A section, of the Zoom chat. All right, so with that, we are recording this session, and it will be available as usual on our SFG YouTube channel for viewing later. Let us dive in. All right, so current and proposed rates. Teresa, walk us through where we are, where we may be going.
Good morning, Dennis. Yeah, this is a hot topic, very debated and discussed right now. And so again, just to reiterate what you said, these are proposed changes. We don't actually know what's going to happen, but we'll go over what we know so far. The chart here that you're seeing is the capital gains rates for married filing jointly. And currently, we have a 0, 15, and 20% tax rates, and you can see the income brackets that each of those relate to. Currently, anything over 496,000 is taxed at the 20% level. We do know that the 0, 15, and 20 is going to remain, but we don't necessarily know how those are going to apply to the income brackets. They may not be exactly where they are now. For example, that second one where it says 80 to 496,000, it may be 80 to 400,000. We just don't know about that, but we do expect the 0, 15, and 20 to remain the same. What we also know, or what they're talking about, this is what we're hearing a lot about, is that over $1 million in income, that rate, once you go over $1 million, you're going up to an ordinary income tax rate on those capital gains over $1 million. And so the ordinary income tax rate also is proposed to increase to 39.6. And I just want to point out, these are just the federal levels. So you have state, if you live in a state with capital gains taxes like we do in North Carolina, that will be on top of these levels. So how can we plan, if we think this is going to happen, and perhaps you have some kind of asset that has a lot of gains in it and you want to sell? How do we plan around this? So one thing is just to look at timing. A lot of the time you can choose when you're going to take some of those gains. So maybe you're retiring next year and expect to be in a lower tax or a lower income level next year. That might be a time to sell your rental property because it won't kick you over this $1 million, threshold. And also, some people are in a sweet spot, I guess is one way to put it, between the ages of when they retire and then, but before they have to start taking RMDs. And those may be lower income years for people as well. So that may be a good time to think about selling some assets that have significant gains. And as far as talking about a budget, if you maybe have a large concentration or of a particular stock, maybe you bought it 20, 30 years ago, and it's grown considerably and there's a lot of appreciation in it, then maybe fill up some tax brackets. Maybe if you have $300,000 in income already, then you can choose to take maybe $700,000 in gains every year for several years until you diversify more fully that position, and just to fill up that under $1 million, keeping your total income under $1 million. That could also work for people who may have a business that they're considering selling. So rather than having a traditional transaction where you're paid upfront for the sale of the business, rather maybe consider installment sales. So receiving that income over a number of years that can hopefully keep you under that threshold. And I just want to remind people that not everything is always sold at a gain. Sometimes we have losses, and just that those can go against your gains. So you can offset your gains with losses, which can be helpful in some situations.
Yeah, good. Thanks, Teresa. And the other thing that we had in our recent poolside chat, where we did a summary of a lot of the tax planning opportunities, is pretty much every other sentence we said, don't let the tax tail wag the financial dog. And so we have a number of clients who have done their financial roadmaps. We have some good visuals of where maybe they might dip into some of those lower brackets. But if a particular asset seems to be peaking in value, and right now we have a number of clients with rental properties in areas that they're a little unsure of for the future, and those properties are possibly 10, 20, 30% over fair market value. Don't wait for the lowest possible bracket. So and particularly if you're in those lower brackets anyway. Now, again, if you're one of the lucky ones and have over the $1 million of income, maybe that suggests some different strategies trying to do in 2021. And I should also remind everybody here that right now, prevailing wisdom is that this will move into 2022 as being effective. But there is a possibility, I don't know that we would call it a probability, that they would make it retroactive back into 2021. So with that fog of uncertainty set aside, let's look at some of the other potential changes that have been discussed. Tara.
Yes, Dennis, thank you. And so we might be adding to the fog a little bit here, but here are some other items that have been discussed is what's going to happen with the marginal rates. We know that marginal rates are based on the income, as Teresa just highlighted on that capital gain slide. And there is discussion that those who are in a marginal rate above 400,000, that bracket would actually go up. And so that's why Teresa highlighted that there may be changes in that level. So we would expect that to go to the higher bracket. The next change that's being discussed is actually not a change. It's to maintain the 3.8% net investment income tax. And so that has made recent news in the last week or so being a little bit more highlighted. And that applies again once you're over certain income levels, around $250,000 for that married filing jointly couple is where it's at today.
Yeah, that particular one roiled the stock market when the administration clarified that net investment income tax would continue to be in the picture. Now, again, that had been actually communicated from the early days of the discussions when Biden was on the campaign trail. So we're not exactly sure why that was a surprise to some people, but we just don't know what will come out with all the wrangling that is going on in Washington in Congress about where the final tax bill will show up. But that particular one, the net investment income tax, seems likely to stay in the picture.
Good reminder. The next one we want to highlight is changes that are proposed around the Social Security tax. So currently on your income, when you earn up to around $140,000, that is subject to Social Security tax and you pay tax on that. And then income above that level is not taxed. The proposal is to keep that level, but then also once you get over around 400,000 to add that Social Security tax back in for the income from 400,000 up to where there's no ceiling on that. So it would have 2 rounds of Social Security tax. The next is the step up in cost basis being eliminated. So currently when someone passes away and you inherit something from them, the day they pass away, instead of what they paid for what you're inheriting, it goes to what its current market value is. So let's just say someone bought a stock and they paid $10 for it. When they pass away, it's worth $100. Under today's law, when you inherit that, your basis would go up to the $100. Under the proposed law, you would keep the basis that the original owner had. And so then you would be paying that gain tax that Teresa talked about on the difference in the value and what the original owner paid for it.
Yeah, in this particular piece, it's been talked about that perfect tax planning would be to buy an asset, real estate, income producing real estate, or a stock, hold on to it forever, and then die with it and have all the income tax wiped out. Now, not very practical in many cases, and certainly in today's world, holding on to something forever, things change in the real estate market, in the stock market, in rebalancing, because again, it's been pointed out that if you actually follow that strategy, your risk tolerance, instead of getting lower as you get older, would actually get higher, which isn't ideal for some people. So apart from the practical side, this step up in cost basis being eliminated, it's been pointed out that the Biden administration talked to a lot of players on both sides, the Republicans and Democrats, and particularly the moderate Democrats, about what would be acceptable, and that was part of the reason that changes in the estate tax law were not specifically put in to the initial discussions, except for this one piece. So that would indicate that it has a potentially higher chance of being in the final legislation. Although again, we've been around for decades watching these processes in Congress. None of them are particularly easy, and this one may be more difficult than some others. And so who knows? But again, we're trying to begin thinking about what would a world look like where step up cost basis is eliminated. So go on, Tara.
The next change that's being discussed is when you contribute to your pre-tax retirement plans. So for example, when you contribute to your employer's 401k, the deduction in tax that you currently receive is based on your marginal rate because it reduces your income. So there's discussion that that reduction in tax would be a 26% around their savings. So it would be a flat savings regardless of your income. So if that does come into play, it will help people who are in a lower bracket below the 26% because they'll save more. But people whose marginal rate is above that 26%, they will actually get a smaller deduction for contributing to those retirement plans. The next change is similar in that in charitable deductions is when you make a charitable deduction, again, your benefit is based on your tax rate, and they are considering capping that benefit out at 28%. So instead of that being an equal deduction across the board, it would have a maximum 28% deduction. So those with marginal rates above the 28% would not save as much in that scenario. The final change I want to highlight is they're going to eliminate the 1031 tax-free exchanges for people who have above $500,000 of income. So that applies, you own a rental property and you want to sell that property. Right now, you can buy a similar property and avoid paying the gain because you're replacing it with a similar item. That's what the 1031 exchange is. And you can delay paying tax on that. But they are going to eliminate that potentially for those with income above 500,000.
Yeah, so again, our belief is that it is more likely than not, many of these things would be happening in 2022, not 2021. And one item that we did not put on this list, because right now it's a bit speculative, is what has been dubbed the Secure Act 2.0. So it was only a couple of years ago they had Secure Act 1.0, and that Secure Act changed the time for getting required minimum distributions from retirement plans. It caused money that was inherited from a retirement plan to the next generation to have to be liquidated and taxes paid within 10 years. They are not talking as much about changing that 10-year rule because, again, I think the federal government would like to have those monies sooner rather than later, not be deferred forever. But they are talking about moving the RMD age to 75. So probably wouldn't affect you if you were already taking your required minimum distributions. Again, a lot of speculation about what's going to happen there. There is one question that has come in about SALT tax and some of the deductions. And because that SALT has affected folks in very high tax states, we have a number of clients in New York and California, for example, there is discussion about removing that. But again, our understanding is that there's a lot of horse trading going on around those issues and some other issues. So unfortunately, our crystal ball is a bit murkier on that one at this point. All right, so let's kind of talk about what we've done for decades at Stearns Financial with clients. We have focused on basically 4 tax strategies. And going forward, these 4 will still be valuable for most people. And again, maybe a lesser or greater degree for folks who are in that over 400,000 or over $1 million taxable income level. Deduct, defer, convert, and tax-free. So deduct is exactly what it sounds like. Look for ways to have tax deductions. And for a lot of our clients, those are somewhat straightforward. There certainly have been limitations from, say, 20 years ago. We could deduct a lot more things, and there's been tightening up of a lot of those so-called loopholes, but there's still areas that things can be deducted. And we're gonna, and when we get to our examples, we're gonna be talking about a few of those. Certainly the 401k or 403b retirement contributions, that's one of the benefits there is you're deducting it. And then you're deferring the tax into a future tax year. Now, one of our frequently asked questions from clients these days is, well, is that going to be as valuable? Well, this gets back to Teresa's comment about your financial roadmap and what it's showing out into the future. We have a lot of clients who will be in a lower tax bracket in retirement. And again, it may vary based on that required minimum distribution, which starts going up as you get into your 80s and 90s. And people are always surprised how much income tax they end up paying. They think they're done with paying income tax when they retire. And unfortunately, if they have large retirement plans, that's not necessarily the case. But the question is, will it still be as valuable? Well, a lot of the roadmap what if scenarios we've been doing suggests, yes, it's still going to be pretty valuable. And if you happen to be in one of those higher brackets, it can still be valuable. We even have an example of that today that we're going to use. But that's, I think, the worry that some folks have is, oh, well, if I deduct it today and my tax bracket's 10% higher 20 years from now when I'm pulling money out. Well, there may be some folks where that actually applies, but deferral is still a very powerful tool. You're essentially making money on Uncle Sam's money that would have been paid to taxes. You're making money on it in the interim. Convert. This is a powerful technique used mostly in real estate, although there's some other areas that convert comes into play. And in real estate, convert just means that ordinary income can be tax sheltered by depreciation and other expenses. And so you take what would normally be ordinary income, taxed at higher rates, convert it into capital gains. Well, again, if you're over $1 million of taxable income under this new law, that may not be as valuable anymore to convert. However, we're going to, again, end this presentation with a discussion of what if you just kick the can down the road? Because one of the things we've noticed, and some of our research sources have noticed, is things are changing more frequently and faster. And so in the next 10 years, we could have another tax law change. We could have 2 tax law changes. So again, maybe that conversion piece doesn't work on its face, but it could work later on if you're using a defer strategy. So this is where you start thinking about combining these 4, not just thinking about them on their own. And then finally, tax-free. When we think about tax-free, sometimes we think about tax-free bonds, which in the old days, when interest rates were higher, were certainly a good alternative for folks in a higher tax bracket. It hasn't been quite as attractive lately, but we anticipate the next 3 to 5 to 7 years that we could see those actually become pretty valuable again. And we are selectively using some things on the investment area that are in that tax-free area that are valuable today. Forget about rising tax rates in the future. So that still is applicable. We have a number of clients who are using the tax-free small business exemption where, and this is more in the aggressive growth category, where you're investing in individual small companies or venture type funds. And those particular provisions, we have not heard that those would go away. In fact, they're trying to promote more entrepreneurial activities. So for certain people who are into that sort of thing, tax-free may still be a benefit. And then we're going to get into one a little bit later. Dax is going to talk to us about qualified opportunity zones, which are actually a pretty powerful tax-free growth mechanism under the changes to the 2017 tax law, which again, from what we've heard, may not be changing in the new tax law. All right. So now we're going to go back to the old meat and potatoes of deduct and defer. So Teresa, what are we looking at?
Exactly. Yes, this is an example here of how, if we're seeing that tax rates are going to go up, if someone's expecting that to happen, then one way to mitigate your taxes is to defer more money into some kind of account. So in this example, we're using a 401k. And we're comparing what it looks like from an income perspective, or I'm sorry, a tax perspective, to if you contribute $5,000 to that 401k versus if you decide to max it out. And this person is age 50. So we're looking at it over 15 years, and the max amount that a person at age 50 and older can put into a 401k is $26,000. So it's a $5,000 contribution versus a $26,000 contribution. And you can see at age 50, someone who puts in $5,000 doesn't reduce his income, his taxable income as much, and therefore has to pay more in tax than the person who puts more away. So if you put more away into a tax deferred account, then that lowers your taxable income, which therefore lowers the tax that you pay. And you can see over time that you consistently pay less in tax by deferring more into a 401k. And if we look at that over a 15-year period, it's a tax savings of about $160,000. This is someone making $400,000 a year in the 35% marginal tax bracket. So the savings for them over that time period is about $160,000. And that's just for 15 years. So if this was someone who started earlier, younger, works longer, that could be obviously more. But, this is one side of the coin to putting more money or deferring more money into these types of accounts. The other side of the coin is really, of course, since you're putting more into the account should have a higher value, which is the next slide that we're going to go into. Thanks. So in this slide, you can see the blue line represents a $5,000 contribution, and the gray is the max, or the $26,000. And by the time this person is 65 years old, it's growing at 7%. Just want to say that. They started with a $1.5 million account value at age 50. And by the time they're 65, their account value is about $5 million if they deferred the max, versus about $430 or $4.3 million if they were only putting in the $5,000, which is a difference of about $700,000 into this account. And keep in mind, this is just based on a 401k, but this person is maybe a business owner and has access to a SEP or a solo 401k, or if they have a 457 through their employer, then they can even defer more than that $26,000 potentially.
Yeah, good. And again, the reminder that too much of a good thing may not be a good thing. So we have talked in many cases in the past in our chats and in our individual planning about what happens if someone gets to retirement and they have 95% of their assets in retirement plans and very little in outside monies. And it becomes awkward. In that case, you lose the benefits of tax diversification. So again, these things need to be weighed off of, maximizing your contribution can be a very good thing, but are you sacrificing something else? Again, as Teresa said, there's several sides to the coin on all these issues.
So I think this slide, one of the points sometimes people make is, okay, I have more money in my 401k at that age, but then I have to pay more in tax on it. Does that make sense? Or should I have taken that same differential, the difference between maxing it out and just putting $5,000? Should I have taken that same amount and maybe put it into some kind of after-tax account that grows not tax deferred? Which one makes more sense? And so what this chart is showing is that if you took that differential, which is about $20,000 a year, and you contributed it to the 401k, which is the orange line, for 15 years, it has a pre-tax value of over $600,000. And if we compare that to an after-tax account, both accounts are growing at 7%. But if we compare that to an after-tax account where you have that $20,000, but you can't actually contribute the full $20,000 to an after-tax account because you have to take it out and pay tax on it first. So you really are only able to put in about $14,000 into that one. So you start out with not being able to put in quite as much because you pay tax on it every year before you're able to contribute it. And then you're taxed on the earnings as you go, which further whittles away the value of that account. And you can see the blue line, or the after-tax account, ends up with a value after 15 years of about $350,000. So in order to compare apples to apples, what we did was take the after-tax equivalent of that 401k. So it's pre-tax, it's worth over $600,000, but after we pay 35% in tax on that, it's really worth about $410,000. So $410,000, still more than the $350,000 after-tax account. That differential, about $65,000 that has of growth, additional growth that's in that 401k. And this is just really showing the power of compounding tax deferred growth.
Yeah. So again, a couple of different ways to filter this for those who are watching who are in potentially going to be in a lower bracket in retirement. That 600,000 plus pre-tax hitting retirement sprinkled out over a number of years may be in a lower tax bracket even and have a bigger differential than the 65,000 in tax savings. Those who are potentially going to be in a much higher bracket in retirement, maybe even higher than they're deducting it now. The question is, how much higher will you be? Will it completely shrink that $65,000 benefit in tax deferral? And it takes a fairly substantial increase in bracket to shrink that all the way back and make it non-beneficial to deduct and defer now. We should also mention time is a wonderful thing for deferring. And so, here we have a 16-year time horizon. May have a different result with this if you're talking about a 5-year time horizon and decisions you're making on a shorter time horizon. All right, and then we get to the topic. This was very popular topic a few years ago, Roth conversions. And we did a gazillion. Tara is smiling because she was in the middle of a lot of those analyses of doing Roth conversions. And one of the things we said back then was, okay, what if we're in higher tax brackets in the future, and how beneficial would a Roth be? So Teresa, walk us through this.
Yeah, those are good questions. I think, first we need to go over why would you convert? Why would you even consider this? And it really is because perhaps you think that you're going to be in a higher tax bracket later on, or if you think that tax rates are going to, just increase generally later on. Maybe you don't want to worry about possible tax changes down the road, and maybe you don't want your kids to have to, when they inherit it, to have to worry about paying taxes on it. So those are some reasons you may consider converting. And in this example, what we're showing is the difference of having a traditional IRA and not converting it, which is the blue line, versus having that traditional IRA and using some after-tax money. It would cost about $40,000, 40% tax, to convert that $100,000. So you use some after-tax savings from another account and you convert this. So you're able to convert the entire $100,000. They both grow at 7%. And you can see that in the end, they end up, the Roth is just under 1.2 million, and the not converting ends up around the 450,000, and that is an after-tax equivalent. So that blue line, we did convert it to make sure that we are comparing apples to apples, because the Roth is essentially after tax as well. And so that comes to over 35-year period, about a $650,000 differential. You can't really see on the graph here, but there is a break even for several years. The not converting is actually the better option. From years 5 through 10, it's probably the better option. And then there's a break even where it flips and the Roth becomes more beneficial.
Yeah.
Sorry.
Now, well, I was going to point out that in the many analyses that we've done of this, if you're not in a higher tax bracket later on, it moves that break-even point out further and further. We had well over 2/3 of the analyses we did actually showed that you wouldn't benefit during your lifetime from a Roth conversion. It would be your children that, or whoever you passed it to, that would benefit. Now, again, facts and circumstances, new tax law, how long will it be in effect? Those are the kinds of things that we need to noodle through as we're doing the analysis that's unique to your own situation.
Yeah, and I just want to add that there are some situations when this won't be a good idea for you if you expect to be in a lower tax bracket later on. That one's sort of obvious. Or if you maybe are expecting your children to inherit it who will consistently be in lower tax brackets than maybe you are because of the career that they're type of career that they're in, or if you're donating to charity, because once charity receives it, they don't have to pay tax on it, so it wouldn't make sense for you to pay the tax up front. So those are just some things to consider if you're thinking about converting. Yep.
So again, the answer here is don't let the takeaway be do Roth in any circumstance, Roth conversion. It needs some careful thought and analysis. All right. Well, so let's move on to another oldie but goodie, tax loss harvesting. We've actually been using this for decades. And so Glenn, talk us through what's happening with tax loss harvesting.
Thanks, Dennis. Yeah, like you say, we have a variety of tools on the investment management side, and this is a traditional tool. And as we'll talk about going forward, there are some newer tools as well. And it just gets back to, we might emphasize certain tools tomorrow that we didn't emphasize as much yesterday, but this has been a very good one historically. When you think about tax loss harvesting, you're really thinking about trying to minimize current taxes or the tax impact today. And so as you can see in this example, and let's start at the bottom with the green section, you're looking at selling a fund A that's had a nice gain, $30,000 worth of capital gains. And we're talking about longer term gains held for more than 1 year. And so you just go ahead and sell it, and you're in the 15% tax bracket in this example. So your gains are 15%, and that comes out about $4,500 of tax owed. So now let's think about if we want to do this tax loss harvesting strategy, and you move up, and now we got this Fund B. And Fund B's got a $15,000 loss, capital loss. So we said, let's go ahead and realize that this year, along with the 30,000 gain that we realized. And now that makes a net gain of 15,000, and it reduces your tax. This is by about half, $2,250 now is what you owe. So this has been a really effective strategy for us for a long time. And we do this periodically throughout the year as we see opportunities. And we've even been utilizing some newer solutions that do this. They really focus in this area, and they've shown some ability to really have some we call tax alpha, where they can actually show a nice after-tax return on the investment compared to the pre-tax return. So there's a variety of tools here, but this has been a very good tried and true strategy for us. And given the proposal that we've been talking about, we'll see how much we use the strategy going forward.
Yeah, well, and this is one where some of those things that Glenn talked about, some of the newer types of strategies that involve even daily tax loss harvesting out of a portfolio. There are various entities we work with that have the capability to do that. Didn't work very well 20 years ago because of transaction costs, but today we have virtually no friction from transaction costs, and we have much more sophisticated tools. Now we're talking about potentially adding that tax alpha piece Glenn mentioned, maybe adding 0.5 to 0.75% to returns over some period of time. Some of the studies we've seen suggest maybe it's a little bit higher in periods of higher volatility. And that sounds like a ho-hum number, but in an environment where the S&P 500 is very likely, in fact, our 3 top research sources say very likely the S&P 500 will make below historical returns over the next 5 years. In that environment, an extra 0.5 to 0.75% may be meaningful. So again, you wouldn't necessarily want to do this if it was creating other problems within your portfolio. So facts and circumstances, and you have to do this sort of thing in a taxable account. So again, if most of your money is in a tax deferred retirement account, this strategy doesn't work at all, because nothing is being no gain or loss until you actually pull something out of the retirement plan. All right, so now we move to one of the ones that is a bit controversial, but it's a natural place a lot of people go. Oh, tax rates are increasing. Should I do gain harvesting, not loss harvesting, but gain harvesting prior to the tax law change? So Glenn, walk us through this one.
Yeah, that's definitely a consideration. It'll be evolving, Dennis. And so, yeah, when you start thinking about gain harvesting and pulling those gains forward, perhaps to this year, for example, this kind of walks through that example. And so here we have, you purchase a stock, and once again, it's a long-term holding 10 years ago. You bought it for $100,000, but now it's worth $200,000. And so when you go to sell this stock, you have a gain, a long-term gain of about $100,000, taking your value minus your cost. And so now you're looking at, in terms of federal capital gains rates, you're looking at, if you're in the 15% bracket, a $15,000 tax bill, or a $20,000 tax bill if you're at the 20% capital gains rate. Now notice this isn't including some of the additional costs like state, if you're in a state that has income tax, we're just looking at the federal expense. But going forward, if this proposal, and once again, we're not saying definitely the 40% is going to come forward on the long-term capital gains rate. We've actually, heard there may be obviously some debate there, and it could be a situation where that gets modified. All that's going to be considered along with the step-up in basis we talked about as well. We've actually heard that the 28% or around that mark is the most effective from a revenue standpoint. So we'll see where it shakes out. But if it is 40%, then now your tax would increase to $40,000. So you can see a material, obviously, increase in your tax bill based on that 40% capital gains rate. And I think, obviously, this is a big decision, like Dennis mentioned, if you do think that taxes are going to be higher down the road. And we can talk about a lot of reasons. We have another example, I think, to go through, but they're, beyond just thinking that, if you got a really low basis stock that's a big part of your portfolio that you've been thinking about holding it to your estate, perhaps, and getting that step up, you might want to re-examine that as well, given that it could be, if it were to be impaired or lose value, it could maybe harm your portfolio and just create a more difficult situation in terms of standard of living. So lots of things to consider here, but this is definitely something that'll be on the forefront given the change.
Yeah, this is the opposite of what we hear from many tax professionals, accountants or tax lawyers, of pay no tax before it's time. All right, well, let's look at this example then, because I think it's a little eye-opening in terms of what it means to actually do this.
Yeah, so we'll use the same example and just kind of talk about it from this perspective. So we still have the $200,000 value here, and we're going to recognize the $100,000 gain. So that's where we have that 20% tax if you're in the 20% bracket, or $20,000 tax, excuse me. So then you say, okay, well, there's a cost here. Now, basically, let's consider if I have to reinvest at a lower number, 180,000 is my net number now. And so I've got to earn more than, to kind of make up for that $20,000 expense, right? And so, you now have to earn 9.3% per year for a 5-year period to get to the same value. And we're assuming that if you'd stayed invested with the 200,000, you're earning 7% per year. So now you got to earn 9.3% per year to get to the same spot 5 years from now as if you held it and just earned 7%. So definitely got to make that up. And it could be a little more challenging if you do think market values are at a point right now where you're thinking returns might be a little tempered going forward. And so it's not an easy decision. And it's like Dennis mentioned earlier, it really gets back to, specifically talking about your situation and having consultation with the client and making sure they know the trade-offs and the pros and cons. But this is definitely a big key part of it when you think about the gain harvesting.
Right. And one of the things that we talked about in our poolside chat is there are going to be many more times where consulting with your tax professional, generally CPAs, but whoever your tax professional is, to do some what if scenarios around these may be even more important than ever. Because there's just so many moving parts. And so you may think that you're benefiting yourself on one side, but may create some other headache on the other side. All right, so Tara, now we're shifting gears again over to charitable planning.
Yes, so first I want to remind everyone of some charitable planning strategies that we often see and how they impact your taxes currently. And I'll highlight how that could change under the new law. But a lot of people, when they donate to charity, they just write a check to charity. And so what happens if you write a check directly to your favorite charity? Well, you save tax based on your marginal rate. So here we said somebody's in the 35% bracket. And so they save about 35 cents on every dollar that they donate to their charity. Now, if the new proposal comes into play, that could be capped at 28 cents if we do cap that at a 28% savings. So we can also build on that. What if you have that appreciated security? So we could use the one that Glenn just talked about. And what we could do is, instead of writing that check to our favorite charity, we could transfer that security directly to our favorite charity. And what happens then is you're able to take that deduction for the fair market value. So you save that 35 cents on the dollar of the value of that security. But what you also save is the capital gain tax, because by transferring the security, you don't pay tax because you didn't realize the gain. And when the charity does sell that security, they don't recognize the gain because they're a charitable organization. So it kind of increases your tax savings there. So as capital gain rates go up, even if we see that 28% max on the charitable donation, this could increase the value of donating appreciated securities.
So talk about, Tara, we have not heard in the new tax law that there would be a change to making contributions out of retirement plans, which we have a number of clients doing, but just talk about that for a second.
Right. And so that's another strategy I was going to mention that did not make it on this slide. But for those who are over the age of 70 and a half, they are able to take directly from their IRA. You cannot do it from your 401k, but directly from your IRA and give to your charity up to $100,000 per person. And what that does is, instead of it being a deduction, you don't actually report the income like you normally would when you take that IRA distribution on your tax return. So it lowers your taxable income. So for those who are eligible to do that and have an IRA that they have funds in that they want to make that deduction, a lot of times that is a greater benefit than even donating these appreciated securities, because again, it's not a deduction, it just reduces your income and never gets reported as income for tax purposes.
And some tax experts have said that if they do away with the stepped up cost basis and change some of the marginal rates, that gifting appreciated securities may actually be better than the retirement plan deduction that you would get. But again, that assumes that this new tax law is in effect for the next 20 years, which again, most of the people that we work with don't believe that is likely at all. In fact, we seem to be in a time of greater change, and we may have one or two tax law changes just in the next 10 years. So always something to think about here.
Yes. And Dennis, the last item on this slide is we can even make donating those appreciated securities of even greater worth sometimes when we do it through a donor advised fund. So if you open a donor advised fund, a lot of times you contribute more than you would in a single year to that donor advised fund. So you contribute maybe that entire position that Glenn was talking about, where you wouldn't give it away to a charitable organization in 1 year. And so you get the deduction benefit, you get the capital gain tax avoiding benefit, but also you're increasing your deductions. And so if you do that in a year where you have more income, that it creates a larger benefit. And that's where a lot of times we do rely on the CPA or the tax preparer to help run these scenarios of what would happen if I went ahead and donated more in that year and then took the standard deduction the following year. On our next couple slides, we're going to run through 2 examples to highlight a more complex charitable planning strategy. And this is really going to highlight what happens if we don't use, or if we do use, a charitable remainder trust. And just to define that, what a charitable remainder trust does is you're able to donate. And again, you can donate that appreciated security. into an irrevocable trust. And when you make that donation, you do not get to deduct the full value of that donation, but you do get to deduct the partial value, and it's an IRS calculation. And so that's where you save on the deduction. And then if you're putting the gain in there, you save by not paying tax on the gain, because again, the gain's going to the charitable organization. And what happens once that charitable remainder trust is funded is you then can get an income stream for a set term or for your life back from that. Now, the income that you do receive is taxed at ordinary income rates, but it's a way to put a large set of money aside that is going to go to charitable organizations once you do pass away or at the end of the term, but also to get that income stream during your life. If you're worried about, hey, if I give this much away, am I going to have a sufficient income stream to support my lifestyle? So first, we're going to look at an example where we're not using that and we're going to create an income stream. So we have purchased a stock for $100,000 long ago, and it's now worth $500,000. So if we sell this stock today, we're going to sell and pay gain on the $400,000 gain. We're going to pay tax on that. And so we would estimate that at a 15% capital gain rate that you would pay $60,000 in tax on that. So once you sell the $500,000 asset, you pay your tax, you have $440,000 to invest. And so we've estimated that if you were to earn a 5% return on your investment, that this would generate $22,000 in income for you every year. And if you live for 26 years, you would have about $572,000 in pre-tax income coming to you. So that's with no charitable remainder trust. Now we're going to look at if we create this income stream, but we do it through the charitable remainder trust. So we put that same asset in there, the $500,000 asset, but because we immediately get a charitable deduction, and we estimated we got to deduct $160,000 in this example, and someone was in the 35% bracket, we actually saved $56,000 in taxes. So now we have $556,000 to contribute to the charitable remainder trust. And when we turn that income into an income stream, we end up with about $27,800 in income per year. So if we look at it over 26 years, we end up with more than $150,000 in additional pre-tax income from doing the charitable remainder trust. So again, as Dennis has hinted at on many other slides, there are pros and cons to this. While the income stream does appear to be larger, we have to remember that, we do get a larger income stream because of the double tax savings, because we're avoiding tax on the sale of the asset and that tax deduction you get when the charitable remainder trust is funded. And we also get to pick what charity that we want the balance to go to at the end of the term or when we pass away. And the charitable remainder trust is protected from creditors. But on the flip side of that, we want to have some charitable intent to do this, because when the term is up, that balance is going to that charitable organization. It's not going to your children. So if you want your children to receive that or some other family member to receive that this is not necessarily going to be a best option for you. There's also some costs to set this up, because the attorney has to prepare some documents, and also you're going to have tax returns prepared that are a little more complicated. So it'll increase your tax return fee. And it's less flexible to diversify. And so once it's in there, and you have the income stream. On the next slide, we'll highlight there are various types of income streams you can create from these remainder trusts. So you can set them up where the remainder trust is a fixed income stream, or it could be a variable income stream. And those are referred to as our crats and our cruts, depending on which income stream you're getting. There's also another nuance, and I won't get into all the details about this, but we've talked about putting that money in there and you receiving that income stream for your life. We can do it backwards. We can put the money in there, and the charitable organization receives that income stream. and your beneficiary actually receives the balance at the end of the term or the end of the life. So that solves some of the problem if you want something to go to someone at the end of your life or end of a term that's not a charitable organization, but still want to have some charitable funding throughout your life.
Yeah, and so I should mention before we move off this topic that some of our friends and clients with major universities are in the audience. And if you set up one of these vehicles with those entities, you can avoid some of the legal costs and ongoing accounting costs. You do give up a bit of flexibility on the naming of the final charitable entity, but if you know for sure who you want to give the money to, then that can be a valuable cost savings. And then the other piece here is that we do have a number of clients who've used charitable remainder trusts. They call it mailbox money. So they have set those up, used it almost like a pension plan with income coming in addition to Social Security and other sources, which has then allowed them to do investment strategies they might not normally have done, maybe more growthy strategies for their next generation, for the kids or grandkids. So a lot of nuances here, a lot of things we need to talk over that are beyond the scope of this presentation, if you have an interest in this. All right, so Dax, now we're going to get into one of the newer tax-free areas. Walk us through what a qualified opportunity zone is.
Perfect. Thank you, Dennis. I think we're approaching the top of the hour, so hopefully I'm not, and qualified opportunity zones aren't the only thing between everybody and lunch, but qualified opportunity zones were created in the 2017 Tax Cut and Jobs Act. And so there are areas located throughout the country that are designated for opportunity investment. And so because of the nature of how they're designated, a lot of these happen to be in and around college towns, but there's also other areas that are designated qualified opportunity zone funds. And they do have a number of tax benefits compared to some of the more traditional real estate investments that we do on behalf of some of our clients here. So the first tax benefit that you can see is the deferral of recognition of capital gain. So let's say if you have a capital gain this year and you invest in a qualified opportunity zone fund, you can actually defer those taxes until 2026. And so you get the benefit of some of that tax deferred growth within your account. When 2026 rolls around, your capital gains will actually decrease by 10%. So you won't have to pay taxes on the whole gain, but you will have to pay taxes on some of the gain in 2026. And then finally, at the disposition of the fund and after year 10 of the investment, whatever appreciation you experience on the growth of your investment will come to you tax-free, at least at the federal level. So we'll next talk about how that might be taxed if you're in the state of North Carolina, because we are actually a non-conforming state. And so on the next slide, you can see that this slide basically is going to break down the tax treatment for qualified opportunity zone investments for North Carolina residents. So under the current tax regime, those are the two columns in the middle. So you can see your taxable investment. We're going to assume that your realized gain was $500,000, both for your taxable gains, $500,000. So if you're going to put this in a non-qualified or an investment that's not a qualified opportunity zone, you're going to be taxed on that. So both at the federal and the state level. The next column, the qualified opportunity zone investment, under the current tax rates in North Carolina, you will be taxed at the state level. And so that's what that represents. And so you can see, and all this is based on the assumptions that we have down below on tax rates, as well as rate of return of 7.5%, that at the end of the day, the potential tax benefit, so basically what you receive in cash afterwards, the differential between the opportunity zone investment versus a non-opportunity zone investment at the end of the period is around $220,000. That tax benefit does decrease under a higher tax regime. So if you do have to pay higher taxes in a number of years, if taxes do go up, the tax benefit had decreased to about $206,000, but you still get a tax benefit by deferring, and then getting the appreciation on the back end tax free. Is still a benefit to invest in the Qualified Opportunity Zone Fund. And then finally, we'll take a look at, because obviously we have clients throughout a number of different states. So we'll look at, various tax regimes, whether that's a high tax state, a moderate tax state, or a no tax state. And so what we're trying to solve for here is, if you are in a various tax regime state, what return would you have to get within a non-qualified opportunity zone investment to account for the difference in tax treatment if we assume a 7.5% return within the opportunity zone? So basically, at the end of 10 years, to have the same amount of cash on hand in a non-opportunity zone investment versus an opportunity zone investment that accrues at 7.5% over that period, what return will we have to get? And so we modeled this both at the 30% federal tax state level, as well as if they go up to 40%. And as you can see, no matter what your state tax regime, there is still a benefit embedded within to invest in opportunity zone funds. So at if we assume a 40% federal tax rate, for example, in a high tax state like California, you need close to a 21% return to equal a 7.5% return within an opportunity zone fund. If we go on the other extreme and we look at a state tax of 0%, like, let's say Florida or somewhere like that, if we do have, even if federal taxes only go up to 30%, so long-term gains only go up to 30%, you'd still need 11.5% return to get the same return of a 7.5% compounding return within an opportunity zone fund. And this is actually all the funds that we're looking at and doing diligence on right now. I think 7.5% is fairly conservative compared to some of the net returns that they're targeting within their funds.
Yeah, so it can be a compelling benefit. Again, we probably would want to say everything in moderation. And so a number of situations that we're looking at right now, if you have a large gain, it may or may not be a good idea to try to wipe out all that gain or kick that can down the road to 2026. But again, it's facts and circumstances on every single situation. So thank you, Dax, for walking through that complex slide. For those of you who like to back up and study, there's a lot to study on those pages. And so finally, we get to what I guess you could also call the kick the can down the road strategy, which is defer paying tax until the next tax law change. Again, as I mentioned earlier, a number of our research entities believe that there's a more frequency of tax law changes. And so you could defer some taxes to a period in the future when you might hope that tax rates are lower. The only danger to that we need to think about is we're in an environment of rising federal budget deficits. And those deficits out 8 to 10 years start getting to the point where the federal government may need to be raising taxes again. So again, very hard to predict even what's going to be in the current tax law, much less what's going to be in tax laws 8 to 10 years from now. And that's some of the scenario planning that I think is extremely valuable that we do with our clients, to think through the pros and cons and just try to make sure that you're making a decision that will stand the test of time. I would also mention that one of the provisions that has been discussed in the new tax law is essentially raising more money for the IRS for tax enforcement of what is already there. So that is a reminder that your auditor may be right around the corner. If you haven't been audited in a while, if you're in those tax brackets where that's more likely, there's probably going to be a lot more enforcement going forward. And so, as always, we suggest that you talk with your tax professional to determine for your deductions, for things you do with a home office, outside businesses, whatever it is, that you color within the lines of your comfort and your tax professional's comfort. All right, with that, we have presented a lot of info today, and we actually only covered about half of all the different things that are possible. We look forward to continuing conversations on this, and particularly with you individually and your own unique situation to determine which, if any of these, are good tax strategies going forward. Again, on behalf of Dax and Glenn and Teresa and Tara, thank you very much for all your contributions to this, and keep those cards and letters coming. Again, your frequently asked questions are what often help us build these particular programs. Again, this program has been recorded and will be available in reasonably short order. You'll get a notice when it's available for viewing on our SFG YouTube channel. With that, I wish you all a safe and happy weekend.